Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Stephen, welcome back to the show.
Thanks, Owen. Thanks for having me again.
We've done another episode just like this one that we're about to do on Accenture. So if you're listening to this, you can go back and listen to the previous episode with Stephen. We also did one earlier on last year, 2019. We talked about the Aoris business, about you and your journey and why you started the international fund. I've got to ask, it's been a couple of years now. How have you found the journey so far with starting your own business and all of that?
Oh, it's a long, deep question, Owen. Look, it's very exciting. It's not often in life you get a blank canvas and you can create something from scratch. So we built an investment team of great minds and other people in the business that interact with our clients. And so building a team of people is one part of it. In defining how you communicate with interested people, trying to stand out, and also always trying to get better. I work very hard to think about what we're doing in every facet of what we do and how we can little by little make improvements in our process, and hopefully that'll generate good results going forward. But it's hard work, but it's exciting, and hopefully we're at an early stage of a long, fruitful journey.
It seems to be fruitful for your investors so far. So far, so good. For those people who may be new to you in the business, I know that the international fund it's a concentrated fund, invests in businesses typically with really wide moats and strong competitive advantages, and you tend to hold them for a long time. There is one thing that I want to get to before we talk about the company, which is Jack Henry and Associates. There's a quote here that you wrote not too long ago, and I'm hoping you can expand on it for our listeners, and I'll just read it off here. It says, "We have a constructive view of our ability to achieve after-fee returns for our investors of 8 to 12% per annum over a 5 to 7 year market cycle." Then you go on to say, "We expect the value of these businesses to rise at an attractive rate over the coming years. And it is this corporate wealth creation that will generate the bulk of our 8 to 12% per annum investment return we seek to achieve. We expect that owning these businesses at some discount to what they are worth, or the value part, will make an additional but smaller contribution to our returns," end quote. Can you explain what you mean there? Because I shared that with my team, and I thought that was a really concise way to describe long-term investing in really good businesses.
Great. Look, it is the essence of at least how we go about investing. And look, when you think about where are the world's great fortunes being created, it's through the wealth creation of great businesses. And I think that's been far more the case. And people who got next quarter's GDP right, or people who picked political outcomes or bet on the gold price. Great businesses have been, I think, the world's greatest source of wealth creation. So for us, as owning a portfolio of businesses, and that's all we do, we own businesses, and that's how we think. We're business owners. As those businesses become progressively more valuable over time, we're participants in that. It's really very simple, common sense investing. So in the same way that someone might own a property that 5 years ago was worth less than it is today, and they've been beneficiaries of that property becoming more valuable, we're participants of great businesses. We talked last time about Accenture. We feel very confident that we can validate the business is worth more than it was 1, 3, and 5 years ago, and will continue to be worth more. And if we can be participants on that, and they don't have to be growing in value at heroic rates, 6, 7, 8% is absolutely fine, and that comes from being able to grow their earnings as they distribute some of those earnings to us as dividends, and that's another additional part. And then the price we own it at, that's also important, but it's not the primary determinant. If we can own them at 15% less than they're worth, for some in our portfolio, it's a bit discount's a bit wider than that. Some it's a bit smaller. But as that discount closes over 5 years, we think that'll add another 2 or 3%. But you can see that that's a small part. And if prices are 5% higher or lower, it's going to make a small difference to our longer term outcomes. The key is that can we own these businesses and participate in their upwards journey of wealth creation and get most of those decisions right. And if we do, then we can create good returns for our clients over time in a low risk fashion.
Yeah, you mentioned heroic returns there and not necessarily going out seeking that. I think that's a really good way to frame it. If you are looking to compound your wealth over a long time, which you are, let's just focus on those businesses that can do that year in, year out. Speaking of, I think we might have found one for today's episode. And the company we're talking about is Jack Henry and Associates. It trades on the NASDAQ. JKHY, I believe, is the ticker code. This is a business, compared to Accenture, this is a business which is about 1/10 the size if we think about market cap. So many people will know Accenture, but Jack Henry and Associates, it's kind of this sleeper and it's a bit smaller, but its track record is arguably as impressive. So a lot of our listeners will be keen to know about this business. It's right in my wheelhouse of businesses too. So I'll hand it over to you, Stephen. Just tell us a bit about the history and what it does.
Oh, great. Well, there's so many things to bring to life with Jack Henry, so I'm pretty excited about the conversation we're about to have. So let's talk about what they do. And they've been in business for more than 4 decades, so they're not new. It has a revenue of about a bit less than $2 billion and a market valuation of about 20. So Jack Henry provides the software that runs banks and credit unions, typically the smaller banks in the US, and we can really bucket what they do into three parts. They describe the first of those buckets, and it's really a third. First of those is core account processing, which means the ledger that records loans and deposits and the transactions in those deposit accounts and loan accounts, really the basic plumbing and record keeping for banks. That's the first one. The second is a whole lot of software that goes around the core, and there's about 100 different modules or solutions that Jack Henry sell. Some of them things like cybersecurity, some of them know your client and document capture and image capture. Some of them are loan approval software. So the whole lot of things that we can do in addition to the core. And then the third of those 3 buckets is payment processing. So when people get excited about MasterCard and Visa card, well, within this, every time there's a transaction on a card, the bank has to record that as well. And Jack Henry generates about a third of its earnings from debit and credit card processing. Those are the 3 buckets. And one of the features of this business is that banks don't like to change this stuff very often because it can be disruptive. So they have a customer retention rate in north of 98%, which is quite special.
I heard the core banking business segment, if you like, and solution that it provides would be akin to the human body and someone's heart. In the banking system, it's kind of, you can't take it out because it does everything. Is that a fair analogy?
Oh yeah, it's a wonderful analogy. And the very largest banks have traditionally built this stuff themselves, but they're probably less inclined to going forward because why employ thousands and thousands of IT people when we can outsource it? So Jack Henry's focus is not those very large banks; it's the thousands and thousands of banks that have a balance sheet of up to say 50 billion. So typically local and community banks and also credit unions. But in the US, all of those financial institutions have in fact outsourced this stuff. There's no more new outsourcing opportunities for that core. But a lot of those banks run on core systems that were built a long time ago that are no longer competitively supported, and they become more and more of a friction for banks. It takes me a long time to create a new credit card product because my core account software was built in the 1970s. It becomes an obstruction to them operating efficiently. So as they turn to who can give me a better solution, Jack Henry's got an absolutely formidable win rate. On the credit union side of their business, here's an interesting statistic. They have 640 customers. In the last 40 years, they've lost 18,
Hmm.
and
Wow.
they've won lots. So they do a great job. And like we were talking about Accenture last week, that creates good organic growth on winning new customers, and there's a lot more the solutions that they can provide to all of those customers. And so the ability to do more is an additional source of growth on top of just winning more banks, which they've got a fantastic record of doing.
I think maybe you can just clear something up for us here, Stephen, and maybe just describe the banking landscape in the US versus here in Australia. Because traditionally here in Australia, we've got the big four and then a few regional banks, but over there it's obviously quite different.
Well, the US banking system is quite different from Australia. We have 4 big banks here and a few smaller ones, some of which in fact are owned by the big guys. We don't have the municipal, the cooperative banks, the credit unions that we find in other countries, including the US. So there's lots of credit unions in the US, and they operate in a very small, perhaps a municipality, and there's lots and lots of state-based and local banks, thousands and thousands and thousands of them. And over time, there's been consolidation among those smaller banks for good reasons. An interesting feature for Jack Henry, though, is that the consolidation doesn't affect them in the way that you might think. You might think, well, 2 banks getting together to make one bank means that for Jack Henry, 2 customers become one. But Jack Henry gets paid based on the number of accounts and the number of customers that bank has. And so the consolidation is a revenue neutral event for Jack Henry.
Yeah, right. How about then when it comes to, I guess, internal growth? So sometimes when we talk about businesses with wide moats and competitive advantages, we often use the term sticky to say that customers hang around for a long time. But sometimes companies are so sticky that getting new clients, you mentioned getting some on board, so we're seeing consolidation. So maybe the industry in the terms of the number isn't growing at an extraordinary rate. But I'm led to believe that Jack Henry is investing a lot of its own capital back into the business to bring new solutions to existing clients.
Yeah, well, if you like, the number of banks may not be growing, but their needs are growing, and that's where Jack Henry can remain relevant and grow its revenue with those banks. And they spend about 13% of revenue on R&D to continue to invest in their products and create new solutions. And that is, when we think about organic growth, has mean that their organic growth has been much like Accenture, about twice the rate of nominal GDP, in that order of more like 7 or 8% over many, many years. In fact, accelerating in the last couple of years. So where does that come from? Well, really a couple of big buckets. One is that a lot of customers who've got this software on premise, they don't want it on premise anymore. Particularly interestingly during COVID, banks are averse to sending people into data centers on the weekend to update security or find problems, if you like. And regulators are also wary of banks with their own data centers. And so there's a shift towards getting Jack Henry, will you host this product for us? Same software, but we're going to take it from our data centers to yours. And so what happens when that shift occurs, and it's about 2/3 of Jack Henry's customers are already using Jack Henry's hosted solution, and there's a long runway for that to continue, is that their spend on Jack Henry's products doubles. So why does that happen? Well, when you go from a big license sale that I might have to write a new check for every 7 years to a subscription annuity model, then it goes from a CapEx item that I might need my CFO to approve to just a monthly budget item. So the scope for the bank to spend a lot more with Jack Henry goes up. The approval process is not quite the roadblock that it can be. And it's a lot easier for Jack Henry to layer in and to sell many of these other 100 solutions that they've got for the bank. And they also, of course, charge the bank for the hosting and all the care and attention that Jack Henry provides when it resides in their data center. So that's one source of growth, is that transition to the cloud, to Jack Henry's cloud, and the ability to sell lots of other products. And then when we think about, the bank's needs are changing, and they're changing rapidly. A good example of that is digital banking. Now, I don't know about you, but I never get excited about going to a bank, particularly in the current environment. And going and queuing in a bank is even less appealing. So the need to do online digital banking is going up rapidly, and I don't want to just check my account. Maybe I want to take out a new account And how can I do that without going into the identification process, putting wet signatures on application forms? What if I want to cancel my credit card? Maybe I've moved state, maybe I've got a new job. So banks have got to enable their customers to do all of this stuff electronically. And Jack Henry has got the one of the market-leading solutions in the US, and they call Banno, that allow their customers to do all of these things. And it matters a lot for the small community banks, because they might have thought, well, I'm not as big as a Bank of America or a JP Morgan Chase. I'm a little community bank, but my competitive advantage is I know my customers' names, and when they come in, I give them a hello. But they're not coming anymore. They want to do their digital banking. So how can I create a digital banking that looks as good as what Chase or Bank of America's got, and has the personal touch that really defines me as a bank? So that's growth in digital banking is a big market, a rapidly growing one that Jack Henry's benefiting from.
Stephen, we hear in Australia, it's quite often lately, this idea of a neobank and these capital light, quote unquote, businesses which are starting up in the banking sector. How does Jack Henry, fare against that type of competitive threat?
Well, the growth of neobanks is driving the need for a lot of their bank customers to come up with digital banking solutions, and that's accelerating their adoption of these digital banking software that Jack Henry provides. And so that's a great driver. Banks a few years ago might have thought that we can just take our time on this. They know that they've got to step on the gas and come up with very good competitive offerings. Maybe if I could just throw in on just a separate comment. So when we think about the software businesses that we've got all these opportunities to invest in overseas, one of the features about Jack Henry that we really like is the barriers to entry in this market are enormous. If you're a new entrant into the bank software market, it's almost impossible for you to displace an existing competitor, because you have to, the risk of failure, the risk of a problem going wrong is catastrophic. And so the reputation that they've built over decades and their ability to continue to come up with new solutions, and as evidenced by their continued growth in market share, it makes this a formidable business. It's a business where the barriers to entry are an enormous advantage.
So one of the things that I know about the banking industry is there's a great deal of risk when it comes to things like fraud. We know that, if you lose some money or the bank loses your money, it's them that is on the hook instead of you. So I'm interested to get your thoughts there around the risk piece, but also around how you think about, the ability of the bank to encourage its customers to be fast followers and to, encourage their customers to embrace the technology that someone else has got. Do you see the cross-sell, is what I'm saying, to be a big opportunity going forward?
Yeah, I think the need for or the cross-selling opportunity driven by digital banking and driven by the ability or the need for the IT infrastructure to go from a liability, if you like, that slows processes down, to an enabler and take costs out, make new product creation, make all the regulatory compliance easier, more fluid, I think is driving the need for Jack Henry software at an accelerating rate. So I don't think they've got to quite go out and sell the banks. I think the banks are hearing it loud and clear from their own customers, the need for this. You mentioned on the security and the loan loss side, that's another important area. One of our other portfolio companies, Experian, the credit bureau, plays very directly into that. How do banks make better credit decisions? How do they recognise losses and risky, particularly right now when there are repayments being missed? How do they make decisions about whether to call in the loan or forbearance? So for Jack Henry, the software that they provide is also important in the loan origination process, the loan processing, the risk identification, all of those decision engines to mitigate losses.
So I guess here's an interesting way to invert this investment thesis, is what would make you sell a business like this?
Well, I think we'd want to see either competitive slippage or slippage in relevance. So are they losing market share? Is there very, very high customer retention at risk of going south? Is there customer satisfaction going south? And one of the things we haven't touched on yet is, look, it's a really key part of the business is their corporate culture. In fact, when we met with the CEO a year or two ago, he gave us his business card, and on the reverse side, it says two things. It says, do what it takes, and do the right thing, and do whatever it takes. It's a key message. And so it's the way to interpret that is, firstly, it's an employee first mantra. We want happy employees, and then happy employees will create happy customers. And they have by far the happiest customers in their industry. And it's a defining feature of the business is high customer satisfaction, which creates retention. Now, if we were to see evidence of that slipping, then that will be another warning sign. They're voted one of the best, not only best companies in America to work for, but one of the best IT companies to work for. So if we saw that slipping, that would be like a warning sign that some of the foundations of what makes the business special are being undermined and eroded. If we saw two of their most direct competitors have each in the last couple of years made very, very large acquisitions, these transformational acquisitions. I think, Jack, we like Jack Henry because they've been true to mission. I think if they were to divert and feel like we're missing out on all the fun, we need to do one of these big acquisitions too. We feel very uncomfortable about that. So we like them sticking to their knitting, growing, focusing on creating new solutions, happy customers. Any evidence of slippage in any of those areas would be a warning sign. If we flip the coin, what else would we sell? Well, price would be one of them. Right now, we feel very good about how it's priced, and we'll be participating in the wealth creation of a wonderful business where the risk characteristics of that business is low, long duration customer relationships, the ability to grow. So, but if the price was up a lot in a short period of time, that would bring into question, is it a great business but no longer at an attractive price?
It's one of those businesses where, and I know it's a crude way to look at it, but to get a sense of a business that's been around for so long, Ben Graham said that, in the long run, the business is a weighing machine. If you look back so long in its history, and Jack Henry's history, just look at the share price, you just see that the beauty of compound interest when a business can just compound each and every year. It's also very conservatively geared, which I thought was an interesting angle on it, because a business that is so reliable, you think you could gear that balance sheet up, right?
Yeah, you raised an interesting point. I think their customers want to know that they're dealing with an organisation that will be around for a long time, and the financial robustness of the business is never in question. So that's a real asset. Now, it comes at a cost that they could take a lot of debt on the balance sheet, make an acquisition, or buy a lot of shares, but they've chosen to operate conservatively. But I think that that's a net positive. It gives their customers comfort. So, yeah, and I think also, like in times like 2020, it's natural for people's sense of time to become compressed. It does take an active effort to go, look, we own a business that's been around decades. The value of the business today is easily forgotten, captures all of its earnings and value creation in decades and years into the future. How do we feel about that today? Is this a business that's built to continue to become more valuable? And 2020 for every business is going to bring its opportunities and challenges, but does that really materially change how we think about the long-term journey of this business and what it's worth today? And here's a business, like Accenture, where the externalities that we're all aware of in 2020 is not destabilizing the business. It's not moving them off that attractive path. It's giving them new things to sell, new ways to be relevant to their customers. It's producing challenges. It's hard to get in front of their customers and pitch. It's the software, when they implement their software that they might have got on a plane and gone somewhere and done it in person, physically. Now they've got to work out ways, which they've done, of, well, actually going to do all this stuff remotely. So it brings its sets of challenges. But as you said, we own long duration assets here, and we've got to think about, we can look back in the rearview mirror at a very attractive long-term history. Are we confident that the business is on a path that projects a continuation of that very long-term history?
It's a fascinating, I'll say little business, because it's probably little by US standards to an extent, but I guess by Australian standards, it's actually a very large business. I know that people can go to your website, Stephen, and find out more about the business. We'll put links in the show notes, and they can keep up to date with all of your latest, research and coverage. One thing I wanted to ask you before we go is, when you think about a business like this, how do you think about it in terms of portfolio positioning? You mentioned last time that you've got a hard cap of 15 positions in the portfolio. How large of a position would this generally start out for you?
Well, when we initiate a position, we recognise that we don't know as much as we'd like to know, even if we've been covering the stock for a long time. So ordinarily, I'd start in our portfolio at about a 4% weight, ordinarily, and then they may build up like Accenture has to be much larger, closer to that 10%, or they may stay around that 4 to 5%. If we feel like, as is the case in Jack Henry, here's a business that we're very confident will continue to become more valuable over time, but at today's prices, it's around fairly valued. And so when we think about that 8 to 12%, we're getting the wealth creation part, but there's a much smaller contribution to be expected from the revaluation part. And so that's the position sizing, if you like. I think the business gets, just to, I guess, take it in a different direction, it gets us excited that while there's a lot of well-known tech businesses that people read about pretty much every time they pick up a paper. Here's one that has so many interesting attributes. It's been around a long time. It's very, very profitable. It's growing fast. There's a big market for them to continue to grow into. But it doesn't sell things to people. It sells things to banks, and so you don't read about it as much. But it's such an interesting tech business in an era where people are getting so excited about technology. But it's one that's just nowhere near the front pages and the radar in the same way that some of the more famous ones are.
Well, not yet, Stephen. So maybe in time we'll wait to see. Maybe when this podcast goes live. Stephen, as always, thank you for taking the time out to join me on the show.
It's been a pleasure. Thank you, Owen.